It's a great friend to be with. Cornelia and Caesar, we wanted to start off by thanking you for taking the time to meet with us today. We wanted to meet with you to let you know that we have found a few issues in the preliminary stages of our audit, but wanted to reassure you that we are here to discuss these issues with you to make sure that you maintain the highest quality of financial reporting. My name is Bill Strasbaugh, and I'm the lead partner on this audit engagement. And with me today are Greg Baker, Senior Manager, Taylor King, Senior Associate, Shuyon Wang, Senior Associate, and John Norcio, Manager. And if you guys are ready, then we can go ahead and begin with the first item on our agenda, the company's HR hiring policies.
So as I'm sure you know, you use an external service called Check On You as your background service provider. And we'd like to talk a little bit about some of the issues that we're seeing there and some of the things that we're on the table.
Okay. And the company's policy is that the background checks need to be submitted to the board of directors to be validated within 6 months of the individual's hiring. And as of February 1st of this year, we have not received any indication that the background checks have been received by HR or submitted to the board of directors for the CFO Douglas Tanner and the COO Melanie Lopez. And I talked with James Miller about this, and he said that the HR department is really, they're really swamped right now, which is understandable considering all of your turnover recently. But I was hoping that you guys might be able to give me an update about where we were in that process.
Well, I'm hearing this for the first time as audit committee members. Did our HR director say anything as to how quickly we can expedite?
He said that they were submitted and that preliminary reports from the background checks showed no indication, but we haven't heard anything beyond that. And so we just wanted to check up on you and make sure that you were aware of this issue, since we want to make sure that the highest quality individuals are occupying your upper management positions. And so is there any way that we could reach out to check on you to follow up on this process as well?
Well, we'll take that on as management. I don't know that would make sense to have you all, but we'll follow up with our HR director to make sure that this gets expedited.
Right, that sounds
we agree
great.
that it needs to be done and put away.
Appreciate you bringing it to our attention.
Yeah.
Well, thank you for that, and we hope to hear from you soon about that.
Okay.
The next thing we wanted to talk about was the composition of your audit committee. As you guys have acknowledged, the current audit committee is a temporary situation, and that it's not an ideal situation for you. But we also found out that you guys have questions about what you need to consider when constructing your audit committee. So if you can look at the first part of Exhibit 1,
Okay.
John will take over and go over the composition of your current audit committee.
Right, so according to Sarbanes-Oxley, the two most important considerations when selecting an audit committee are independence and financial expertise. Sarbanes-Oxley requires that all audit committee members be independent from the filing company, and that at least one member have proper financial expertise relating to financial reporting. Under the current Fox audit committee composition, it needs rework in order for both these requirements to be fulfilled. Currently, only Caesar, you are the only one who meets the independence requirements, which is a major reason why there needs to be rework, because Cordelia, as CEO, you're a direct affiliate to the company, and therefore do not meet the independence requirements. And
Yeah, I see the big fat no.
Yes. Yeah, we laid it out graphically, so it's just easier to look at and understand.
So it looks like you're suggesting a complete overhaul of the audit committee.
Yeah.
So I can't be a member of the audit committee. I mean, I don't have any independence issues with the company.
Right, you don't have any independence issues, but it is very important that financial experts be on the audit committee in order to.
Everyone has to be a financial expert?
Not everyone. Only one is required to be, but it's important to recognize that the goal of the audit committee is to fulfill responsibilities of oversight of the financial reporting process, which can include providing oversight regarding effective internal control, performance of the audit committee, performance of the internal auditors, and performance of meeting other regulatory and legal requirements. And so a more independent and a more financially knowledgeable audit committee would go a long way in ensuring all these responsibilities are fulfilled, which will protect shareholders and protect the financial reporting process as well. So while not everybody is required to be a financial expert, it could go a long way in helping fulfill these responsibilities.
So because I run my own business and I've been pretty successful, I understand the finance operations of my companies that I own. Still not a financial expert.
Well, not necessarily. I mean, we just provided an example in the second table, and it's an example. It's not in any way a recommendation. So, if you feel that, Caesar, you are the correct choice, and the board of director feels that you have the financial expertise that is important to have to be part of the audit committee, then you should go along with that.
All right.
But we provided just an example of 3 members who we thought would be a good example of a proper audit committee.
Excellent. Thank you.
All right, that's good, thanks.
So I think next on our agenda is Taylor, if you don't have any more questions about the audit committee.
We have a lot of work to do.
So as you can see, we've proposed an adjusting entry for the contingent liability in relation to the consumer complaint back in December. Since it is both probable and estimable that the customer complaint will result in a loss of $500,000, we think it is in the company's best interest to report this contingent liability in 2012 financial statements. Also, it is a financial accounting standard, number 5, and all of this is a requirement. We also think it is in the company's best interest to do this anyways. It'll provide.
You said it's not a requirement?
It is a requirement.
Okay.
Yes, but even if it wasn't, it's in the company's best interest because it's the most conservative approach, and we at Ernst & Young believe it's very important for our clients to take a conservative approach. And also it will provide the most reliable information to your investors, so definitely a good approach to take. And also in the future, if there were to be, like you wouldn't have to pay it out, then we could just reverse the journal entry and we could remove it from your books.
So if
It's
we,
a little concerning.
Yeah.
I don't know that we want to necessarily practice conservatism. We want to practice following the right answer.
According to your law firm, we received a letter from them stating that it was probable that it would result in a reward of $500,000 paid out from the company. And so we think that is actually, instead of just being the most conservative, it's also the most accurate way of approaching this situation.
and what was management's stance on this?
That you currently felt that you didn't need to book this contingent liability.
I know we feel probably pretty passionate about our ability to withhold this claim. So no, we definitely heard your opinion, and we probably need to circle back and reach a decision, but there's some opinions clear.
And then, Shion, if you wanted to go ahead and start talking about the accounts receivable adjustment entry.
Okay, next I will talk briefly about the adjustment entry for accounts receivables. During our testing of the balance of allowance for accounts receivables during the season, we discovered a computation error in the agent analysis. As a result, the allowance balance is understated by $34,500, and we talked about $34,000.
And you guys are proposing an entry for that? Pretty small?
Yeah, for us, we agree that it's not a very big problem on its own, but at the later stage of our audit, we will aggregate and adjust the misstatements and compare the summary with the materiality. So we need to make sure that the summary falls below the materiality level to issue an unqualified opinion. So we strongly recommend adjusting entry right now to save your efforts in the future. Yeah. And second of all, as I just mentioned, this adjusted misstatement stems from error in the computer system, which is very systematic error. And we believe that this has an impact on the control risk, which has elevated our control risk as regards to the audit of this account. So we believe that we will reduce our reliance on the internal controls of your company with respect to the accounts receivables. So we will expand the scope of substantive testing at this stage, digging more deeper into the actual accounting records. And this might increase the time of our work in the future, so we will really appreciate your help in the future process.
Okay, guys, I know that we've we've spoken about this before, and I feel like, and after a conversation with Douglas Tanner, I wanted to bring your attention at least to our third exhibit, or our third sheet. Now, as you know, when we spoke year-end, we had budgeted about $1.2 million for our audit fees in regard to inventory. With the move up in the acquisition date of Bow Wow, and given the obvious consolidated total assets increasing from about $350 million to about $660 million, we had to do a great deal more audit work, I guess, within the sector. And I wanted to at least give you a good breakdown on this page of some of our processes that we went through. I mean, as you probably know, when you acquire a company, you have to test your intangibles, your tangible assets, take a physical count of inventory, look at the impairment on potential goodwill and things to that effect. So we were able to come up with a pretty round number that we felt like we needed to increase our audit fees due to the increased inventory acquisition. And as you can see in the third line, we had about 87% increased total assets within the company, and we felt like we were able to find a good round number of about $250,000, which represented only about a 20% change in our audit fees, given the scope of services we had to perform on these new assets.
So when I think about what's really changed as a result of the acquisition, where's the audit effort? Because, some of the things that you just mentioned, so intangible asset impairment testing, I'm pretty sure from talking with Douglas, they do a really good job of pulling that stuff together, passing that on to you. And what's the audit hours, what's that changing, and how's that moving up? Because we're talking about inventories, we're talking about intangible assets testing, but we kind of do all the groundwork.
I mean, at least for us, from our perspective, and getting a good feel for this new part of the business, we wanted to go in and confirm all of these amounts. I mean, obviously, you have a physical count that was taken prior to the acquisition that we took on. And we felt like going in there and actually getting our own count, making sure that we could